Hey everybody, this is Kevin Brinkman, and you are listening to the Brinkman Report. In our last episode, our guest suggested instead of listening to economists and journalists to understand the economy, we should talk to hedge fund leaders who actually have skin in the game and are putting big bets on where they see the economy going. And luckily, we have Joe Hegener today, who is exactly that. So welcome, Joe. Thanks for joining us.
Thanks for having me.
All right, so it's an interesting time to have this conversation. Just thinking over the last week, CPI fell 0.1%. So annualized, that's a 3%. And I always think if you analyze the last month, that's negative 1.2%. But I know we don't always look at it that way. We've had an uptick in unemployment to 4.1. S&P has just rocked 26% since last year. And then we follow the CME group. FedWatch shows a 90% chance of a Fed cut in September. And then, we had a attempted assassination on the Republican nominee and the Democratic nominee getting out of the race 30 days before the convention and about 100 days before the election. So plenty to talk about today, but I want to start. Start with you, Joe. Could you give us a little bit of background on your professional bio and background, please?
Sure. Yeah, sure. So, I studied economics at university when I graduated. I was in New York. I was in analytics and advisory at BlackRock in Manhattan there for a handful of years. From there, I went to PIMCO, and I was working on a portfolio management desk at PIMCO. Collectively, that desk managed about 125 billion across a number of different mandates and investment guidelines. I left PIMCO in 2019, and I started with some partners a hedge fund. I ran that hedge fund for a couple of years. There's a multi-asset focus, and January of 2020 was a heck of a time to launch a new investment strategy. But thankfully, we came out of that pretty well. We were the number 2 performing hedge fund on Preqin, which is a kind of an alternatives database for back-to-back years, 2020, 2021. I spun out of that venture in late 2021 to start the firm we have now, Asterozoa Management. We have a hedge fund, a number of other investment strategies, and we also sub-advise a liquid alternative credit ETF, which the ticker is on the New York Stock Exchange, CRDT, or credit.
Awesome. Well, appreciate it. Would you mind spending just a little bit more time on each of those strategies so we understand how you spend your time, what your focus is?
Yeah, absolutely. So we're predominantly credit focused, liquid credit focused. So we're focusing on interest rates, credit spreads, anything that's really publicly traded predominantly. The ETF in particular, right, is daily liquidity for a retail audience. We're looking at mostly investment grade all the way down to high yield corporate bonds, as well as structured credit investments like residential mortgage-backed securities, CLOs, commercial mortgage-backed securities, other ABS type products. And then over the top of all of that, we like to hedge our overall portfolio. That's one of the differentiators between a traditional long-only fixed income portfolio or index, and in our strategy, it's hedged using credit default swaps, interest rate futures. The idea is to build a portfolio that kicks off current income and is otherwise very stable. But over the top of all of that, we like to overlay hedge products that have kind of tail risk convexity profiles, to where if it hits the fan, or God forbid, their assassination attempt went a different way, or if Jerome Powell got fired, or if China invaded Taiwan, right? There's all these there's a whole litany of scenarios that could take place plausibly that could create a really big problem in financial markets. And we want to try to get our head wrapped around what could happen and purchase inexpensive protection where it's viable.
Perfect. Great. Well, you're the perfect person for us to hear from today. That's actually, putting their money to work and making big bets on where you think the economy and the market's going to go. Wanted to start just high level. Maybe start in GDP. Are you in the hard landing, soft landing, or no landing camp? Where do you think we're going?
I think that fiscal policy over the last handful of years has really mitigated and muted a monetary tightening, attempt of monetary tightening by the Fed. And everybody's aware that our current fiscal spending and our current deficit is completely unsustainable.
Mm-hmm.
At the current rate of spending, I am in the no landing camp. I think the fiscal and monetary policy are pretty much canceling each other out. We're at an interesting inflection point here with the election and potentially a pretty seismic shift in how fiscal spending is sort of allocated, I suppose. And so it's fairly kind of binary in my opinion, in the sense that if everything was held equal, if we took today's world and we projected it forward, then I would be in the soft to no landing camp. I think inflation is coming down, consistently. All the supply chain risk that's largely been kind of resolved or mitigated. Housing data is holding up pretty well. Consumer spending is coming in a little bit, but that's relative to all-time highs in terms of household balance sheets. Overall, the economy looks pretty good, in my opinion. But you need to account for the fact that there's been an enormous amount of fiscal stimulus that's been injected into the system over the last handful of years post-COVID. Yeah. And that's not going to be here forever. And so
let me ask you about that. It seems like if irregardless of which party wins, neither of them are campaigning on deficit reduction. So are you you thinking more it's how that fiscal spending is allocated, or do you really think that it changes with the election? Because I think we're going to be 4 years out before we're even having that conversation again.
Yeah, I hear you. You're absolutely right. I think no matter who wins, the deficit is going to get worse, and generally politicians don't change anything until it's the absolute most critical time to do it, which I don't think anything's going to break necessarily in the system in the next 4 years. However, what keeps me up at night is inflation's been coming down nicely. However, if we were to get somebody in office who really, really put their foot on the gas, right, cut taxes, government stimulus, either in the form of direct stimulus or tax breaks or incentives.
Or drill, baby, drill.
Yeah, exactly.
Yeah.
That very likely reaccelerates inflation.
Mm-hmm.
And that's the scenario that really keeps me up at night, where the Fed cuts twice in 2024, and in mid 2025, inflation starts to reaccelerate.
Yeah.
And that's very likely where you get a U-turn from the Fed, and then Fed's credibility is called into question. That's very likely a stagflationary environment where the economy is continuing to cool and slow, but the Fed can't cut because the inflation backdrop effectively. And I think that scenario is underappreciated. I'm not necessarily saying it's the base case, but it's pretty likely. And and with stock markets at all-time highs and credit spreads at all-time lows or near them, I'm personally of the volition that protection to the downside is very inexpensive right now. It's pretty prudent to be purchasing that. You still have to sort of play the game and be invested as a fund manager, but we're not sticking our necks out right now. I want to see how, and I think the Fed does too, by the way. I think the Fed, as it relates to when we might get an interest rate cut, I think they want to see who's going to be in office and what their fiscal plan is. Jay Powell has been iterating a handful of times in the last few meetings that fiscal policy plays a big role in the trajectory of interest rates. And there's a lot of uncertainty there right now.
So what's your forecast for Fed funds rate? Right now, we track the Fed Watch, it's at 90% for a 25 BIP cut in September, and then high 80s for another 25 BIP cut by the end of the year.
I think
How does that feel?
I think that feels right. I mean, I would maybe fade the September a little bit in terms of, 90% seems pretty well baked in, and that's prior to the election. Now the Bank of Canada just cut this morning, and so we're starting to see the easing cycle take place. The curve has really actually been steepening quite a bit today on that news. Yeah, I think it's more likely than not we get one in September and one in the fourth quarter. However, I probably put the September at like closer to 50%. Longer term, I think the neutral rate, the Fed's preferred rate at which it's neither stimulative or restrictive, is probably in the threes. Right now it's kind of assumed that that's in the twos. Larry Summers has been kind of shouting this from the rooftops for a while now. Is the economy post COVID, from a productivity standpoint, is actually much more robust than in the kind of the low and slow years of 2010 to 2020, and therefore, a 5% Fed funds rate isn't necessarily as restrictive as you think. If we're assuming that the neutral rate is 2.5 and the Fed funds is at 5.5, then we're assuming that that's 300 basis points of tightening. When in fact, Larry Summers thinks their neutral rate's in the low fours, in which case, in the last few years, we've only really had 100 basis points of actual tightening, which would explain why everybody's been waiting around for this hard or soft landing and nothing's really happened today.
Yeah. But even if it went down 200, 250 bips, I mean, most of our listeners are real estate investors, and that's a huge deal. Transaction volume. I mean, it's really probably to get to positive financial leverage right now, we're probably 50 to 75 bips off. So even 100 bip reduction is a huge difference, and it turns the whole, market back on. So just that alone and getting even to a higher neutral rate, I think would work. And so that's on the, the short end. A lot of our loans and a lot of multifamily owners, they're on the 7-year, 10-year Treasury as their index with Freddie, Fannie agency debt. So, we've had an inverted yield curve for 18 months?
Yeah.
So, you mentioned the debt before. When I look at the debt clock, it's almost 35 trillion. So how does that play out? At what point does our debt get so large that really, we shouldn't be thinking yields are really going to be coming down?
Yeah, so it's interesting you say that, because that's actually our highest conviction trade at the moment. That's where we have the most chips on the table, so to speak, is in yield curve steepening, right? So the yield curve has been inverted for the longest period on a consecutive basis ever. And the curve itself, the 2s10s, the 2-year versus the 10-year interest rate, has only ever really been inverted for over a couple of weeks, 4 or 5 times in financial markets history. And typically once there's an easing cycle that's put into place, or once the Fed starts cutting rates after a tightening period, every single time the curve has steepened or normalized back to how it should be shaped, which is positively sloped, right? Intrinsically, that makes sense, where the 10-year should yield more than the 2-year because of this concept of term premium. And 98% of financial markets history, the curve is positively shaped or positively sloped. It's just in kind of exceptional periods of history of extreme tightening where you get this relative inversion, where the Fed is holding the short end higher, and everybody knows that at some point it will come down, and the market's effectively pricing that the 10-year, the overnight rate rather, in 10 years from now will be lower. That leads to the inversion. So within rate futures, you can actually play this on a relatively attractive risk-adjusted basis, where if I'm long 5 units of the 2-year Treasury and I'm short 1 unit of the 10-year Treasury, that's net duration neutral, or net interest rate risk neutral, in terms of if rates on a parallel basis go higher or lower. But what drives your mark-to-market value, whether that be a gain or loss, is the relative inversion or the relative steepness of the curve. And that's our highest conviction trade at the moment, because we're in the very early innings of an interest rate easing cycle. So we think that the 2-year treasury in the front end is going to come down considerably over the next 12 months or so. At the same time, which you alluded to, there's this fiscal deficit and this sort of concept of term premium that's really being baked back into the markets. And that's something I think maybe as real estate investors, I would consider, where even if the Fed cuts by 200 basis points, it's still fairly likely that the 10-year rate is higher than where it is today.
When we talk to multifamily owners and sellers, they hear, interest rates are going to come down in the next 12 months and I'm going to wait. But the reality for multifamily, if it's on a 7-year, 10-year Freddie Fannie loan, there's almost no correlation, right?
Yeah, exactly.
And so that helps maybe construction loans, maybe some bank loans that are on SOFR. But that will be interesting on anything that has an index of the kind of a 7-10-year treasury. So, I mean, if you had your best guess, is the 10-year 12 to 18 months from now lower, higher than it is right now?
I personally think it'll be higher than where it is today.
Yeah.
The 2s10. So actually, we have 2s20s trade on right now, 2-year versus the 20-year, and that's actually that's broken its inversion very recently. It was inverted for a while, and now it sits today. It's the 20-year is 20 basis points higher than the 2-year. I personally think that net needs to be about 300 basis points, or about 3%. Historically,
so it's a huge difference, right?
Yeah, oh yeah, yeah.
And so how much of that's on the short end coming down compared to the long end going up?
I think the short end goes down by 100, 150 basis points, and the long end goes up by about the same.
Wow, it's a lot. Okay, that's a contrarian view,
yes.
Right? Especially on the long end.
yes, it is.
Okay.
I mean, there are two different markets across the yield curve, in my opinion, right? I mean, the Fed really drives everything at the front end, and then the long end is really, to your point, it's uncorrelated really to what the Federal overnight rate is, the Federal Reserve overnight rate. It has much more to do with the markets themselves, the buyers and sellers of long end bonds, whether it be insurance companies, Japanese institutions in the JPY carry trade, the fiscal solvency of the government itself. I mean, there are all these different factors that play into the volatility around the long end of the curve that are just completely trumped by the Fed directly moving the overnight rate at the front end. And so as we kind of enter this easing cycle, I definitely expect the front end to come down. There are a number of identifiable risks that lead me to believe that rates being higher at the long end is not only kind of my base case, but it's also on a risk adjusted basis, or like a probability weighted basis. I think it's an attractive position to be in because it's contrarian. So you can actually build exposure into that trade at a very attractive level, right? In financial markets, which it might not be perfectly parallel to real estate, but it might rhyme. Where if everybody is super, hyped up on a particular subsector, whether it be like the AI trade, or if it's a very crowded trade, everybody knows that interest rates are going to go down at the front end. The risk return profile on a trade like that is not super attractive because everything's already sort of known. A lot of the upside's already been captured. And in fact, it's usually negatively convex in the sense that you might be able to clip some coupons along the way and get a little bit of upside, but you're kind of picking up pennies in front of the steamroller if that trade reverses. So we try to take the other side of that. We try to avoid popular trades and look to more contrarian type plays.
I'm just trying to think back to the Fed funds rate. When we get to that neutral rate, When do you think that is? Because if you're thinking maybe inflation could turn on a little bit more next year, Fed probably will be on hold a little bit. So are you thinking 2026, 27, or when do we get there?
Yeah, I think again, a lot could change with regards to fiscal stance, but I think the end of 25, early 26, I think we could be there.
Okay. Okay. Yeah. So, I mean, I take away from this conversation on interest rates that I think there's pretty good consensus that the front end is coming down, right? And the Fed is starting to lean that way. I think the big question mark is what the middle and the longer end of the curve, what that does. And I've just
Yes.
kind of concluded it's almost like chaos theory. There's just so many different variables in there, that who knows? Just like how the Trump trade turned it on a little bit, and who would have thought there'd be assassination attempt and things like this that are so hard to price in.
There's something that I like to refer to in some of the commentary that I put out to our investors. So I've got the 2-year versus the 10-year charted out in front of
Yeah.
me. Can you see my Bloomberg screen here?
I can. Yep.
Okay, great. So charted on the top is the 2-year and the 10-year index. The 10-year is the white line, the 2-year is the orange line. Down below is the difference, right? So right now, this red right here in the bottom right is the inversion that we're talking about. At the very most inverted point, when we really started to pound the table, was when the 2-year versus 10-year was about 100 basis points inverted. That only ever happened in the Paul Volcker days, where he was really trying to squash inflation. So you can see over, ever since 1975, 2s, 10s has only really been inverted 1, 2, 3, 4, kind of 5, 6 times.
And is it true that there's always been a recession after that inversion?
No, that's not true, but it's
Okay.
like 90% of the time. I think we avoided it once of the 6 times.
Okay.
But what I point to here is that if you watch the 2-year, right, and you kind of map it versus the relative steepness of the curve, this right here is an easing cycle, right? Interest rates coming down. Same thing here, same thing here, same thing here, right? And it's about to be same thing here, right? Every single time we've emerged from a 2s, 10s inversion, it's been on the back of an easing cycle. And on average, the relative steepness, or the 10-year on average, was about 240 basis points higher than the 2-year, which are these peaks down here at the bottom, right? So that's sort of what we're expecting to happen here. And you can see we're tracking, pretty nicely towards something like 150 basis point, normalization, if you will.
Yeah, I mean, that's a big deal if that happens for real estate. As I mentioned, I think we're within 100 bips from things really turning on in the transaction wise. So the time frame you're thinking that happens in is 12 to 24 months, probably, right?
Yeah, I think it happens very quickly, these types of things. A lot of it has to do with just fund manager positioning, and typically a trade is contrarian for a long time, and then all of a sudden it's sort of the potentially the new accepted ethos, and that's typically when momentum really builds, and it happens very quickly. So I expect 100 basis points of steepening in the next 12 months.
Okay. I wanted to pivot. In real estate, obviously interest rates are really important. GDP, who really cares unless how it applies to your properties? That one of the big thing is employment, and especially for multifamily. How many people are employed, have jobs that can, afford rent, pay rent, have their own apartment. And I was just thinking that the Wall Street Journal came out with an article today with the title, "The Hottest Job Market in a Generation is Over." So they're basically saying it's over. What's your forecast for the health of the labor market?
Oh, man. Yeah, I mean, I definitely don't see any sort of catalyst that would create mass layoffs or anything close to like 08, 09 type of a period. There are some warning signs as it relates to, the consumer, but on the whole, corporate balance sheets are actually fairly solid. The debt interest costs is a concern as loans get refinanced at higher rates, but small business and medium-sized business, which, as I'm sure you know, employs most of America, they've lost a lot of access to regional bank lending, and that is certainly going to reverberate through the system. I wouldn't say it's such an extreme catalyst to where we see unemployment spike, but I do expect a soft deterioration. The last 10 years, particularly before the Fed's hiked by 500 basis points, and certainly during the post-COVID stimulated years, if you were a small business, people were just throwing money at you. Like, you could get financing at 0% interest rate. You could hire anybody you wanted, everybody you wanted. And that's just not this current situation, right? I mean, there's a lot of businesses that have not necessarily, they haven't shuttered or anything like that. They're still employing, they're still positive margin, they're still chugging along, but they've pulled back on the expansion plans. They might be looking to trim some fat to try to increase margin where they're getting hurt on some other things in terms of the high cost of input cost. And so, as a real estate investor, I think it's super important, obviously, just to look at the businesses in the area, because it's so localized, those types of markets, and then who are the major employers? Because if it's a business that is somewhat bloated and might have high input costs, might have debt servicing issues. I'll give you like a very mega cap example, like Verizon Wireless is a huge investment grade issuer, right? But Verizon Wireless has a huge debt problem. Like, they're not going to be able to invest in growth. They're certainly not going to be looking to add headcount anytime soon. They've got a huge balance sheet, and on the whole, they can do what they need to in the near term. But for context on the debt, right? Verizon has $177 billion of debt. The average cost of that debt is 1.6%.
Wow, because they locked it in.
Yes.
4 years ago.
Yes, because they locked in tens of billions of dollars at 0.5 coupon, 0.75, 1.5, and it's good for them, right? They locked in 30-year paper at 0.5%. Good for you.
Just like 70% of the homeowners, right? They did the same thing.
Exactly. Yep. And that's another part of the reason I think that this lag effect has been to financial markets and monetary policy is so much longer than other periods, is because, sure, the Fed hikes by 500 basis points, but if you don't need to refi anytime soon, it doesn't really matter, right? I mean, every Tom, Dick, and Jane was able to lock in 0% financing, and, real estate loans are inherently short-term loans. And so those get rolled over much quicker than some other forms of debt, which is why we're probably seeing some stress on the commercial real estate side of things. But at some point, that debt needs to get rolled, right? And so back to the Verizon example, they've got $35 billion due in the next 3 years or so. That's going to need to get rolled at wherever triple Bs are currently being financed, which is SOFR plus 75, I want to say. So it's going to go from a 1.6% cost of debt to a 6.25% cost of debt, all else equal. This is a company that only does 12 billion or so in free cash flow. It's going to be like a 25 to 40% hit to their free cash flow generation. And that's just on the debt servicing costs. That doesn't even have anything to do with, inflation and input costs or anything like that.
How many companies like that are there? In real estate, we have really good data on, on this wall of maturities and how much got extended from last year, when they're maturing. Is it a big chunk of the economy and enough to really tip the scales for kind of a GDP and everything else?
I would say there are a lot of corporate balance sheets that look like this and financial profiles.
Yeah.
However, and bankruptcies are ticking up quite a bit. But there have been a surprising amount of private restructurings, a lot of kicking the can, if you will, right? So, another example, Carvana had no cash on hand. At the time, they were free cash flow negative. They never made money. They had $3 billion due in 2024. They had 1.5, I think, due in March, and another 1.5 due in November. And they didn't have the money to pay it. They were literally listing their real estate as liquidity on their earnings reports. And they effectively, the creditors went to them and they kind of said, hey, look, we know you can't pay us. We don't want you guys to default because then we're going to recover nothing. So why don't we just extend the maturity out to 2030? We'll increase the coupon, but we'll make it pay in kind. So you'll get some cash, ease of that burden, I suppose. And we'll move up in terms of seniority. We'll go from unsecured to having a lien on the assets. And they took a haircut, $1 billion haircut to do it. And so, the Apollos and the PIMCOs of the world can say, look, we've got these new bonds, they're 15% coupon, even though they're not getting paid that in interest. And on paper, everything's good, right? Carvana avoided bankruptcy. But there's a real question that, in a few years from now, are they going to be able to pay off all of that debt?
Yeah.
$5-6 billion worth? Maybe. Maybe they turn it around and they start generating substantial free cash flow and chip away at that big debt pile. There are a lot of issuers that have done that in 2024. I mean, billions of dollars worth. So
all that's going to be a little bit of a dampener on growth, on employment. And it's not saying it's going to go negative, but so what do you see the unemployment rate going to? We're at, I think it just ticked up to 4.1. You see that staying in kind of the low fours?
I personally think it's going to slowly keep going into the low fives personally.
Okay.
Yeah. Over a couple of years, the debt overhang is so great on corporate America. And, I really don't think that, monetary policy, like rates aren't going back to zero, right? It's just not, right? They could come down, and depending on what sector of the economy you're in, 100 basis points could be very meaningful, to your point, or it could be a drop in the bucket in terms of what you need in order to stay solvent. And that spectrum is pretty wide, but there's going to be, I think, a substantial overhang for years to come. And the problem with, fiscally putting your foot on the gas and cutting taxes and stimulating the crap out of the economy is that we're just getting back to somewhat normalized inflation. And if that starts to reaccelerate, I think that could be a really panicked scenario in financial markets and the economy.
So as we're getting to the end here, do you have any other black swan kind of events that you're tracking that you don't think people are paying enough attention to?
Oh boy. Well, there's tons of stuff that is out there that I think about, but something I think the greatest. So I already talked about inflation reaccelerating, but I think the greatest risk to the global economy and financial markets, as measured by impact and probability of taking place, is China invading Taiwan. There are unsubstantiated stories about Taiwan Semi having, booby trapped their own production facilities in Taiwan in the event of a takeover, just to keep the proprietary hard tech, from going into Chinese hands. Taiwan generates 60-70% of all of the semiconductors in the world. If you take that offline, I mean, what happens to the global economy? We experienced a very, very small piece of that in late 2020, right? When we took semis offline because of supply chain issues, and car prices went crazy, like supply chains halted. If you did that, imagine that times 20. And not to mention, right, the biggest names in the S&P 500, what happens to NVIDIA, right? If they can't source chips, Google, Microsoft, Apple. you know, that's a 30% hit to the S&P 500 very quickly, right? Yeah.
And
So
I've asked for your crystal ball this whole conversation. What would you handicap that at China invading Taiwan in the next 5 years? Is it a 10% or more like a 50% or a 1%?
I mean, I'm not a geopolitical analyst, but I have, listened to enough of them to where I put it as more likely than not. Every former general that I've listened to and gone to conferences and heard geopolitical analysts talk, it's all of these guys are all saying it's not if, it's when. Sure, these are, you got to take their biases with a grain of salt as well. But I think it's a very underappreciated risk. And something that we're trying to hedge for, but boy, that's a tough one.
Well, last question for you is, a lot of our listeners are always looking for new sources to read, to listen to. You mentioned the journals you've listened to. Assume a lot of your data comes from Bloomberg, but what other recommendations, suggestions could you give to people who want to be as smart as you on these topics?
I read a lot of financial markets news. Every Financial Times, I try to read every Economist. It's hard to keep up with that. As well as Bloomberg does a pretty good job of putting out interesting pieces. I try to stay on top of those cool events. I like Financial Times a little bit better than Wall Street Journal because it has a more global approach, the way that they cover media. And then an individual I think that might be worth checking out. A partner firm of ours, Simplify ETFs. They are our partners on the ETF that we manage, CRDT. There's a gentleman over there who's their chief strategist, Mike Green, and he's put out a lot of research on the structure of financial markets. I highly recommend taking a look at his stuff. He has some really unique insight, and definitely not afraid to take a contrarian, ethos, where he thinks it's appropriate.
Awesome. Well, thanks for your time, Joe. We greatly appreciate it. We'll put your contact info and those references in the show notes. So thanks for joining us, and we look forward to seeing everyone next month.
Sounds good. Thank you.
Bye-bye.
Take care.
Thanks, Joe.